Good morning, traders. It is 7:59. Wow, I'm on my game today, starting just a minute too early. Uh, there's a lot to get done today before the open. Volatility continues. Welcome to the Trader Bite, episode number 2179. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. Here's what we're looking at this morning. This is the Convergent Trading pre-market summary sheet passed to Convergent members, also posted on Twitter every morning. More information on Convergent Trading at convergenttrading.com. So risk on sentiment. Look at Europe today. Europe, which was just absolutely hammered yesterday, is caught up and pushing higher. The market is in a risk-on posture this morning. Russia is moving into Kyiv. And by the way, in case you didn't know, it's not Kiev. Kiev is what it was under the USSR. That's the Russian way to say Kyiv. For Ukrainians, it is Kyiv. So when you hear Kiev, you should cringe. This is something that became obvious to me a couple days ago, and I just wanted to share into the culture. Anyway, Russia moving into Kyiv. U.S. durable goods, personal income, and spending came out strong this morning, giving us part of the pop. Also part of the pop, a key element to this pop higher is a headline that said that the Russian government is ready to sit down with the Ukrainian government to talk about some sort of discussions, and the market shot up on that news, and it shot up on that news. There is fighting going on. Russia says it's ready to send a delegation to Minsk for talks with the Ukraine. The Kremlin saying the demilitarization by the Ukrainians is absolutely critical part of Ukraine's neutrality. So, I mean, that takes a lot of, pardon the term, that takes a lot of balls. You're moving into someone's land and you're saying we'll only talk if the military backs off while they're trying to defend their land. It's anyway, it's just the world is upside down, and it's been for a while, I guess. Maybe I'm just getting old. But one of the key things to know here, is there's still some real news event risk. And that's the news flow is just continuous. There's a lot of headline risk today. As far as earnings, I'm not going to cover that. There's not anything significant. Canadian Imperial Bank and Sempra pre-market, post-close, there's not much doing. As I said, a bunch of numbers came out this morning. Inflation rate out of France came in stronger, 3.6 versus 3.2 consensus. ECB's Lagarde spoke, and then again, U.S. durable goods, personal income spending all came out very strong. PCE price index came in at 0.6, the prior 0.5 forecast, 0.2 year-on-year PCE price index, which is the last of the price-based economic figures before next month's Fed meeting. The year-on-year came in at 6.1 versus 5.9. We're still waiting on pending home sales this morning, expecting negative 5.1 year-on-year and a strong 6% month-on-month for January. Michigan sentiment final, which is not the same as the prelim. The prelim has already passed, expecting 61.7, not expecting that to be a mover. And 11 o'clock today, Fed's monetary policy report. So other than that, crude's still under pressure. Under pressure, that Queen song. And crude's still under pressure. There are steps being taken by various governments to help the supply crunch as a result of this Russian-Ukrainian conflict. to make up for some of the supply that's being pulled off the table. And so crude fell precipitously from above $100 down into $92 and is holding steady at $90, $92, $91 here. The metals are off. The metals are basically backing off to where they were before, really not responding the way people talk about in books and in macro economics about how metals would respond in case of crisis. Let's talk about the S&P. The S&P has a trend up profile. The auction condition is trend up. For those of you, since you're here on a Friday, I'm going to just throw some setups at you that occurred this morning, trend-based setups. And remember, I want to remind everyone that you should have, as a trader, you should or must have a way of trading the market in balance and a way of trading the market when it's out of balance. Market's heavily out of balance currently. And so you have to approach the market in two different ways. They are not the same. You can almost consider them like they're completely different markets. Convergent members, I would refer you back to the webinar from a couple weeks ago about trading markets in balance. And to everybody else, I would refer you to the description in the YouTube broadcast. If you open the description, you will see a link to a video about trading and high volatility that handles some of the imbalance condition. So the S&P is traded quite a bit, 442,000 this morning, much higher than we would normally expect. The range is 90 points, much higher than what we would normally expect. It's about 2.5 sigma of the last 252 days. Inventories negative is short 55%. Short 55%, so 55% of the total volume occurred below yesterday's settlement, which was at 42.84. The point of control at 42.60. And we will project that range forward into the day session. So the range is settling down a little bit, but the range is still quite wide. Remember, we're only expecting about 41 to 45 points in the day. And the overnight session has already covered 90, and generally we at least mirror the overnight session since, statistically speaking, since in general, in a normal distribution, we take out the overnight high, the overnight low, approximately 95 to 97% historically. So we generally extend the overnight range. It doesn't mean the day range. The day range might hit the overnight stat and not go anywhere. We may end up with a 15-point range on a 90-point overnight range, but it's not likely. Very, very improbable. So again, prepare yourself for volatility, which means widening stops. You can see the rotations right here. Widening stops and widening targets. And because we're widening stops and targets, we have to cut our size. If you're trading minis, go to micros. There are 10 micros per mini. If you're in micros, cut back on size a little more. If you have to trade a one lot, do so. If you're already at a one lot, I highly, highly, highly recommend you don't trade live. Go to a simulator and participate and practice your plan and execute your plan, because the process is what makes money. It's not the individual trades that make money. I know that's counterintuitive, but the individual trades don't make money. It's your process that pays the bills. So keep practicing your process in a volatile market to see if your plan is still good in a volatile market while adjusting for volatility. That's a lot to take in. I know I'm covering a lot here, but that's where we stand. I'm going to somewhat skip the review from yesterday. I mean, there's just a lot of rotations here from yesterday. It's a very noisy chart. But what we did yesterday, quite a bit of, is we really skated along. The biggest thing you have to come in with yesterday's trading is that the overnight inventory was 100% short. 100% short. We didn't trade above settlement at all. So that's one piece. This is why we cover the overnight inventory. The second piece is we opened up, and our test below the open was very weak. So we opened at 12.5. We tested 4108.75, and then we had our first impulse right here, our first impulse to the upside. You don't want to get short in that situation. You just don't want to get short. There's an opportunity for a small short here, which was correct, 42. I did narrate that short in the Convergent Trading Head Trader channel. There was a run, there was a trade for a run into 42, and there was a flip at 42 for a short back into the RTH VWAP. So this is full session VWAP, full session mid, then RTH VWAP, RTH mid. And what we did is we skipped and bounced right off of the RTH levels. There was no reason to get short yesterday. We kept the open beneath us, and we kept balancing and rebalancing the inventory, and there was just no let up. You can't see it here, but there's no let up from Delta buyers. There was a lot more aggression on the buy side. That while we saw icebergs all over the place yesterday. If you traded yesterday, you saw icebergs at every fifth handle. Every fifth handle had, it was really tough to hold a long yesterday. Every fifth handle had thousands of contracts. Just trading, coming off strong, then coming back, trading, then popping through, coming back, and then trading for support, and then continuing. So there was a lot of iceberg trading going on, a lot of positioning, a lot of hedging, a lot of OTF. So we finally end up making creating the IB high at 4183.50, pulling back once again to the RTH VWAP, RTH mid. Then we make a run again for the IB, break it, pull back, and then continue, pull back to the full session mid, and then we continue on, and here we tap the RTH VWAP, and so on and so forth. I'm plotting both RTH and full session VWAP. I generally don't know which one the market will respect, but I'm just an observant of price until things happen. Yesterday's profile was technically a normal variation day. The auction facilitated trade very well to the upside. It did not bounce the developing point of control too heavily. Right in here, it seemed to have found balance right between the 4160 to 4180, and then it took off and it pulled back to the mid, which I expected wouldn't hold, but it did. I was totally wrong. In fact, there were several occasions yesterday, if I'm being transparent, and I like being transparent, there were several occasions yesterday where I would say something and the market will do the exact opposite just a few seconds later. So clearly out of the flow of the action yesterday. However, you could still make money in it. You don't have to be right. You just have to have your four elements of a winning trade in place for things to work out. So we ended up finishing in this 83 area yesterday, and taking back the settlement from the prior day and finishing positive. Here's what we have done overnight. This is the overnight session on a clean chart. We open up, we never test the, hang on. We open up right here. We never test all the way down into that 83. Again, we ran up into, after the close, we ran up, we had a bunch of earnings. We ran up, we never retest, and then we continue higher into today's session. Yesterday, settlement was 42.84. 42.84, and we've been running up since then. We took out the 4,300 Here are the stock zones for today. This is the price map for today. The over under for today is 42.50, which we traded around this evening. The overnight session right here. We tested, retested. The magnet once again is 43, 43, 43, 44. That is the high volume node, the composite high volume node. That's the balance zone. And then just above there is the key resistance at 43.68, 43.68. So support, key support, 42.09. The over-under is beneath us, so bullish, looking bullish this morning coming in with a magnet just above at 43.43. And then key resistance just 20 points, 25 points above that. That's how things are shaping up. Just to give you a little bit of a nugget for being here, trend day trading. This is a very common play on trend day trading. You have a high, you put in a high, you break out, you put in a high, then you come back to the prior high, base, push for a new high, then you come back to the prior high. You still have to, don't expect the market to turn on a dime. The market is never going to, when it does, it's actually a pleasant surprise that it stops right at the level and turns around. Everybody likes to point that out. It's a miracle. But in general, pulling back to 88, going to 84.50. Currently stops are about 5.5 points. And then it continues. Then it comes back to the prior high and so on and so forth. And when it stops doing that, that's your first indication that the trend is getting weaker. Generally, I see that in my rotational charts. These are the rotations, right? So I can see that there's potentially more expansion to the downside than there is to the upside. And so I start to recognize that this thing is getting weak and to back off longs. But in general, if you have these big rotations up, small rotations down before it turns again, these are areas you'd want to stay long. So instead of using an oscillator or, like RSI, MACDs, or CCI or whatever, which you can use, I don't like doing that because there's a lagging component. There's, it's a 14 period look back or 21 period look back. Rotations are in real time, and I can see that they're breaching. If we see that the last rotation down was, say, 8 points, and then this one is 10.5 points, but it's still holding prices a little bit higher, it tells me something. It is saying that the sellers are able to rotate the market farther than they did before. They should have, the buyers should have defended, but did not. And so I start to get an inkling that that I need to take it easy, being aggressive with the long. The good thing about trading the trend this way is that you can pretty much identify risk. If you create a profile, which I call an intra profile of that zipper, you'll find that there's a point of control in there. I would not want it below the point of control. So I want to gauge the pullback to a price action distance, so a fixed stop distance, but also I want to use and lean against the intra profile point of control. That's just a little setup for you, or a little help with a setup for you. You can see right now the market is pulling back right into balance here. The point of control for this is right there. This bar here is indicating that sellers are weakening into the open. It's not as easily defended as it's been. And so and so if there's something to lean against up here, I will start looking short on a weaker high and looking for a break of that low, if that is in fact a low. Stuff like that. So this is I just wanted to throw that at you as a way of looking at profiles. What am I looking at here? My trigger chart is an 1 tick by 8 tick point and figure chart. The overall chart is 1 tick by 20. This means that the point figure chart is not going to create a new bar unless there's a reversal of 20 ticks or better, which is 5 points currently. You can also go to a 30-minute, 60-minute, or whatever, but I try to avoid using time-based charts because I just want to see the action. I make money or lose money based on the action, not based on time. So I prefer to stay away from time-based charts, but maybe I'm just closed-minded, and you can do better with time-based charts. Just use what works for you. Okay, so that's where we stand. Looking at what we've done overall. Here's the week so far. This is a shortened week. We had a holiday on Monday, so Tuesday, Wednesday, Thursday. You can see we gapped down. We had a gap down, way down below 4150 into 4100 almost, and then we came straight back. And what this represents is a taper at the bottom. So we have an excess low in the S&P. This is an excess low. This low is expected to be here for a while. This is your new equivalent of what happened right here, except we opened and we had basically an open drive push higher yesterday. This is an intermediate term low. If things change with the Ukraine-Russia situation, and by the way, what led the market to rally like this? There are many factors that led to this, but one that is kind of silent in there is the pricing or the probabilities of the Fed rate hike and the magnitude of it eased yesterday. There was also some comments by a Fed speaker that said that they may have to slow down the taper, and that's where we saw the market just ramp up. This is where a news feed really helps. So people are like, oh, we're going to war, and the market loves war, so it's rallying. It has nothing to do with that. The market is already beat up. Techs led the push higher. Techs have really gotten punched in the throat quite good for the last 2 months. And this is almost a relief rally that was also supported by the fact that oil was coming off. A lot of fear that the input of the energy market is going to be a further drag on prices, causing further inflation. So that's coming off. It's back to where it was earlier this month at $92. And on top of that, the probabilities of a strong taper and an aggressive rate hike came off the table, and that basically is feeding the market. The market should respond that way and should reprice the way it did. It did its job. So here we are today. Here we are at the current week's developing point of control at 4,300. We are really in this area where we're coming into balance, as you can see right there, and then we're coming into the 43.43. This is expected to be the key resistance area, or the key magnet area with key resistance, and on the next low volume node above. So to me, this looks like the most attractive price here in the area is 43.43. We're testing from below. As soon as it gets into 43.43, be careful. It is likely to get turbulent in two-way once it gets in there. We would need more news to push higher. Okay, time is up. But just remember, we're coming back into the developing point of control of the week. We're right on top of it. So this morning, even though we're opening in a small gap, we have to expect what? Those of you who have been around for a while, please answer this properly. What do we expect now that we're opening right on top of the developing point of control in a gap from yesterday's high? We're trading at 4,300. The developing point of control at 4,300. What do we expect, folks? Yes, we expect chop on the open. We expect a very wide and choppy open because of that. And that's what the probabilities show. And so we're looking for the market we're looking to not be so aggressive on the open and let the market tell us which side is winning before we start to hammer on it. This morning, open auction. So again, the inventory still quite short. I'm expecting an open auction. I'm looking for it to pull back to 42.90, get back and get us into the prior settle at 42.84, get us that stat, try to push lower, and then I'm looking for, again, buyers to come right back in, again, probably led by the tech market, and I'm looking for this thing to squeeze the overnight high. Now we're getting back into the prior week's low, 43.21. We're likely to battle it out here at 21. Resistance from the week before this week's low. And then if we break, that's likely to be support. And then the target becomes 43. I don't know if it'll make it to 43 today, but that's the map. That's what we're looking for. We're looking for it to continue the way it has been. The market has really overcorrected in a way. All of this you can throw out given the headline risk. The secondary is an open auction, that has a driving component to it, gets us up into 1750, gets us into the 21, fails to hold the 21, pull back to 21, and then impulse down back to the open, and then we start to make our trip back into the prior day's range. And then in that situation, I'm looking for it to push all the way down to 42.60-ish. I don't know, 42.70, 42.60 right here, 70, 60. I don't know if it'll go down that far, but I'm expecting the range to be relatively wide. And in this case, the range is only 60 points. It's very attainable. If the buy scenario kicks in around 84, 80 or so, even 75 to 43, we're only talking about 70 points to get up here. So it has a lot of room to be able to do it. It is Friday. There's no long weekend or anything. And I believe some of the shorts are likely to cover their position given how yesterday played out. So the skew is to the buy side. Risk on sentiment, as you saw in the conversion trading pre-market summary sheet. Good luck today, and I'll catch you later. We were going to do where are you from today, but we're out of time. Take care, and don't. If you need a trading account, if you need a broker, go to EdgeClear. That's the company that I own and started for serious active traders, futures traders, edgeclear.com. And then, of course, my trading platform is edgeprox.com. Good luck.